Hey everybody, Spartan from SpartanTrading.com. Want to hit you guys with a quick little video, and in this video I want to talk specifically about credit spreads, what they are, how they work, why we would do them. I've talked a little bit about spreads in other videos, mainly debit spreads, which are going net long something, paying for something. Credit spreads are going short an option. Now, why would we do a credit spread over just doing a naked short? I'm sure you guys have heard the term, going naked short on a call or a put. Well, the reason we would want to do a naked call or put short is we take on limited risk overnight, essentially, on those types of trades. Let's say I took something like Apple, for instance, on the short side. If I took Apple, a 130 put short, and let's say some news came out and Apple opened up at $1.25 or even $1.20, I can take a huge loss on that naked short put. Let's say it cost me 30 cents. A 30-cent credit, now it could be down $10. So now I'm down $10 per contract. Whereas if you did a credit spread, you limit the amount of exposure you have to those types of events occurring. So if I did, let's say, Apple 130 to 128 credit spread, the max I could lose on that is $2 versus, whatever it goes down, $10, it go down $15, etc. So it really mitigates the amount you will lose by, essentially hedging that trade a little bit, or actually putting in more of a stop area where at some point, if it goes below 128, then that 128 put that you own is just going to start generating income and offset the losses from the 130, the difference between the two. So your only loss is just going to be that $2, that interval between. So credit spreads, it's a good idea to generate income. It's a safer way to do income generation trades, so you don't have to worry about those kind of black swans events happening over the course of the evening. But let's talk about exactly what a credit spread is. So a credit spread or a net credit spread is an option strategy that involves a purchase of one option and the sale of another option. Now, you probably remember bull call spreads, or if you've watched that video. If you've watched a vertical bull call spread, that video, I talk about how those work. When we do a bull call spread, what we're doing is the inverse of this. So a normal bull call spread would be looking for, let's say I think Apple can go to $140, but not higher than that. I could grab 135 calls and I would sell the 140 calls against it. My max profit on that would be $1.50. And for next week, that would be a cost of $1.31. And the reason I know that is because I've done the math already. Almost a 3-to-1 risk reward ratio, let's call it, to the upside. And does it have a decent probability of working? Possibly. It does. We can't know for sure. But, obviously Apple's holding the trend. It looks bullish. It could get continuation next week to the upside. Fair enough. A credit spread would be looking to make some money based off of taking in premium from options. So watching the premiums decay to zero and making that money from that decay. Now, if we think we can do a credit spread on Apple, let's just look at an example here. Actually, first, let's rip through just this little example here. So this is just a theoretical example I have of what a credit spread would look like. So the opposite of a bull call spread in this case, and we're talking about the call side. So in this case, if I wanted to take a credit spread on Apple, and let's say my strike or my expiration I was just going to go next week on Apple, I'm going to be going short the 140 calls, and I'm going to be going long the 150 calls. And this just ensures that if anything bad happens, and let's say Apple just goes to $180 overnight for some reason, that I'm only losing $10 max per contract. So it does essentially cut off what my max loss could be, or cut off what my losses could be if I didn't control them as well. So it acts as essentially like a stop. In this case, let's say I wanted to do that. What would that actually look like on Apple? So let's say I wanted to go after 140 and 150 credit spread for next week. And let's see what that makes sense, or what that looks like. Let's actually just do it this way. So we'll look at the last prices of Apple. So let's go 140 call, which is 74 cents. So this is what you're going to be short, 74 cents, which is the 140 calls. And you're going to be long the 150s for next week, which are worth 11 cents. So your credit is going to be 63 cents. So you think it's a very high probability that Apple won't get in the money. I would say it probably is. Those 140s probably won't get in the money next week. And if they don't get in the money by expiration, you're going to make 63 cents per contract. So again, this is an income generation strategy. You would do a credit spread to ensure that your max loss is capped. And yeah, you can do these all the time. You can do them to the upside, to the downside. Inversely, if you wanted to do a put credit spread, it would be the exact same thing, but to the downside. So you'd be short the 120s, for instance, and long the 115s. Max loss capped at $5, and you would make the difference between, or whatever that credit would be on that put spread. So credit spread's good idea for income generation if you're one of those types of traders who likes to generate income off of premium decay on the option side. Certainly makes sense to also, look at the chart, see if there's any catalysts coming up, make sure that those options don't have a great chance of getting in the money. We want to make sure that those probabilities stay extremely high. And the reason why is these types of trades have a risk-reward ratio that's skewed against you. So we have to keep that in mind if things do go wrong. The other thing to keep in mind is you can also set stops on credit spread. So even though there's a 10-point interval where I could lose 10 points, you could also have a stop at 250, $4, whatever you think makes the most sense. So again, just wanted to quickly talk about credit spreads. I know I've had a couple questions on them. Hopefully this does clear them up. Otherwise, if you guys have any questions, you can go to SpartanTrading.com. Thanks for watching, and I'll talk to you guys next week.